Hello, I'm David Cassidy with the market update today, Thursday, the 25th of June. As global equity markets are currently trading on every news headline, the mood has quickly turned from positive to negative. As a result, global equity markets fell heavily yesterday, and this has unfortunately followed through into this morning's trading. For example, on Wall Street, the Dow Jones fell over 700 points, or just over 2.7%, while the broader S&P 500 index fell nearly 2.6%. In the UK yesterday, the FTSE 100 fell nearly 200 points, or 3.11%. It's initially opened this morning down a further 90 points, just over 1.5%, although as the day has progressed it has recovered and is now trading slightly up, around 0.1%. The reasons for this negative sentiment are threefold. Firstly, coronavirus continues to spread in the US, with states including California and Florida recording the largest daily increases in infections. Secondly, news that Donald Trump was considering tariffs on $3.1 billion of imports from the UK and the EU. And thirdly, that the IMF, the International Monetary Fund, said it now expects a deeper recession than it expected 2 months ago. Now, although we fully understand and appreciate that this market volatility is unsettling, and we are advocates of caution and risk management when it comes to managing our clients' investments, we believe it is completely wrong to be despondent and say that the recent rally has run its course or that global equity markets will now sell off. While these localized coronavirus outbreaks in the US could slow the US recovery if it keeps unemployment levels elevated, we do need to put everything into perspective. The number of cases as a proportion of those tested is declining, albeit slowly, across most of the country, as the new infections tend to be more localized. And as we've been reporting, the US economic data is recovering. In addition, fresh lockdowns have, by and large, been ruled out by US politicians. Furthermore, evidence from Asia and Europe suggests a second wave isn't an inevitability. So, with reference to the potential US tariffs, while this would obviously be unhelpful to UK and EU companies as they start to emerge from the coronavirus lockdowns, the proposed $3.1 billion levy on imports is a small drop in the ocean, given that the US imports nearly $500 billion of goods from the EU and the UK. As such, this appears to perhaps simply be political posturing ahead of the US presidential elections in November, especially as the announcement came shortly after the EU said that it was considering stopping Americans from entering the region until the US coronavirus outbreak is fully under control. So while last night's news headlines were dominated by the IMF after they lowered the 2020 growth forecast for the UK from minus 6.5 to minus 10.2 due to the coronavirus lockdowns, it wasn't a surprise to us, given we've been saying in these commentaries that the UK economy would probably shrink by high single digits or low double digits. In fact, the IMF didn't actually say anything that we didn't already know. In other words, the economy has hit a brick wall thanks to the coronavirus lockdown restrictions. Regular viewers of our commentaries will know that this is not like a normal economic downturn, as the coronavirus outbreak is a transient issue. And as such, we believe that while we will experience a sharp and painful economic downturn, it should also be relatively short, with a sharp acceleration on the other side of this horrible coronavirus outbreak, as much of our expenditure is only being delayed. Hence our view that 2021 could be one of the strongest years for economic growth since the global financial crisis back in 2008-2009. Unfortunately, we do all need to accept that equity markets hate uncertainty and therefore volatility will remain elevated in the short term. However, yesterday and today's moves look to us simply to be another case of equity markets playing on the swings and is not a big slide. In the meantime, our attention is on analysing today's US initial jobless claims and US durable goods orders, which we will update you about in tomorrow's commentary.